In 1976, a man named John Bogle launched a brand new kind of investment, and almost nobody wanted it. He was trying to raise $150 million. He raised 11. Wall Street laughed at him so hard they nicknamed it Bogle's Folly and called the whole idea un-American. Here is the part that should make you sit up. That mocked little experiment grew into a strategy that now controls trillions of dollars, and decades of hard data show it quietly beats the highly paid professionals who laughed at it. By the end of this video, you will understand exactly what Bogle built, why it works, and how you can use the same tool the wealthy use to grow money while you sleep. Let's get into it. Start with a simple problem. Picture walking into a market where fruit is only sold in giant expensive boxes. A box of apples is $100. A box of bananas is $100. A box of grapes is $100. You have $100 in your pocket, so you can buy exactly one box. If that single box turns out rotten, you have lost everything. Now picture 10 neighbors who each toss $10 into one shared bucket. Suddenly that bucket holds $100, and the group buys a mix of apples, bananas, and grapes, then splits it evenly. You still spent only your $10, but now you own a slice of every fruit. If the apples go bad, your bananas and grapes carry you. That shared bucket is the entire idea behind an investment fund. It is a giant pool of money collected from thousands of regular people and used to buy a wide mix of assets at once, so no single bad apple can wipe you out. Spreading your money this way has a name, and it is the closest thing investing has to a free lunch. When you put everything into one stock, your future is welded to one company. If that business makes a bad product or collapses, your savings vanish with it. A fund fixes that the second you buy in. One share can spread your money across hundreds or even thousands of companies, technology firms, grocery chains, car makers, oil giants, all at the same time. If one company has a terrible year, the other 99 can carry your balance. History shows how powerful this is. Going back to 1926, the S&P 500, a basket of America's largest companies, has returned about 10% per year on average. $100 invested back then, with profits reinvested, would be worth nearly $2 million today. That is what owning the whole basket does over a lifetime. Now, funds come in a few flavors, and the differences decide how much money stays in your pocket. The oldest type is the mutual fund. Here, a professional called a fund manager runs the pool. They spend all day studying the economy, reading company reports, and trying to pick winners that beat the market. That hands-on style is called active investing, and because you are paying an expert to work every day, mutual funds charge a yearly fee called an expense ratio. Watch that fee like a hawk because it eats your returns silently year after year, whether the manager does a good job or not. That brings us back to Bogle's invention, the index fund. To get it, you first need to know what an index is. An index is just a scoreboard tracking a group of companies. The S&P 500 tracks the 500 biggest public companies in America. Instead of hiring an expensive human to guess which stocks will win, an index fund uses software to simply buy every company on that scoreboard. It copies the market. No star manager, no daily guessing, so the fees are tiny, and the results are where it gets uncomfortable for Wall Street. The S&P indices versus active scorecard, which has tracked this question for over 2 decades, found that over a 20-year period, more than 92% of active large-cap fund managers failed to beat a plain S&P 500 index fund. Over the most recent single year, nearly 79% still lost to the index. Paying more for a professional usually got people less. That is why so much smart money now flows the quiet, cheap, passive route. How tiny are those fees really? The average index stock fund now charges about 0.05% a year. The average active stock fund charges around 0.64%, more than 12 times as much. Some funds have gone all the way to zero. Fidelity offers index funds with a 0.00% expense ratio and no minimum to start. On $100,000 over 30 years, the gap between a cheap fund and an expensive one can quietly cost you tens of thousands of dollars, money that simply evaporates into fees instead of compounding for you. There is a close cousin to the index fund worth knowing, the ETF, short for Exchange Traded Fund. It holds a diversified basket just like an index fund, but the way you trade it is different. A traditional mutual fund or index fund only prices once a day after the market closes. An ETF trades on the open exchange all day long, just like a single stock. Its price moving every second the market is open. The very first one, the S&P 500, launched on January 22nd, 1993. From that single fund, the global ETF market has exploded to nearly $20 trillion by the end of 2025. ETFs carry a second quiet advantage too. Because of the clever way their shares are created and redeemed behind the scenes, they rarely trigger surprise tax bills. In 2024, only about 5% of ETFs handed investors a capital gains tax bill, compared with 43% of mutual funds. With a mutual fund, the manager's trading can stick you with a tax bill even in a year you never sold a thing. Funds do not only buy stocks. A bond fund pools money to buy bonds, which are basically loans you give to a government or a large company in exchange for regular interest. Bonds are steadier than stocks. They do not swing as wildly, but their long-term growth is usually lower. That is why many people blend stock funds and bond funds together, trading a little growth for a smoother ride. You can also become a landlord without ever unclogging a toilet through a REIT, a real estate investment trust. Congress created REITs back in 1960 specifically so ordinary people could own a slice of big commercial property. A REIT pools money to buy apartment buildings, malls, hospitals, and warehouses, collects the rent, and by law must pay out at least 90% of its taxable income to investors as dividends. Today, REITs in the U.S. own more than $4.5 trillion in property, and around half of all Americans are invested in them, often without realizing it. The real magic shows up when you leave money alone and let compounding work. When companies in your fund earn profits, many pay out cash called dividends. Instead of pocketing that cash, you can set your account to automatically buy more shares with it. Now you own more shares, which throw off even bigger dividends next time, which buy even more shares. Over 20 or 30 years, that loop snowballs a modest monthly habit into a serious pile of money, and you never lifted a finger. If picking between stock and bond funds sounds like a headache, the industry built a hands-free answer called a target date fund. You just pick the year you plan to retire, buy a 2060 fund, and while you are young, it leans aggressively into stocks for growth, then automatically shifts towards safer bonds as 2060 approaches, protecting what you have built. It runs on autopilot, which is exactly why these funds now hold roughly $4.8 trillion and have become the default in most workplace retirement plans. If you want to bet on one slice of the economy sector and thematic funds let you focus on a single industry, technology, healthcare, clean energy, artificial intelligence, the upside can be big if that industry booms. But the risk is higher because you have thrown away the safety of broad diversification. If that one sector hits a wall, your fund falls hard with it. Here is the honest part. Funds are far safer than single stocks, but they are not risk-free. Your value will rise and fall with the economy. The trick is knowing the market moves in cycles. Black Monday in October of 1987 saw stocks drop more than 20% in a single day. The 2008 crash took about 5.5 years to fully recover. The 2020 COVID crash erased a third of the market in weeks, then made it all back in roughly 5 months. Every major crash in history has so far been followed by a recovery and new record highs. You only truly lose money when you panic and sell at the bottom. Calm investors hold through the storm. So how do you start, especially if you do not have much? The barriers are basically gone. Since late 2019, when the big brokerages dropped trading commissions to zero, and with fractional shares now standard, you can begin buying index funds and ETFs with as little as $1. You do not need a fortune. The thing that actually builds wealth is not the size of your first deposit, it is how consistently you keep investing and how long you let it compound. One smart habit makes this almost foolproof. Rather than trying to guess the perfect moment to buy, which even pros get wrong, you invest a fixed amount on a fixed schedule. Say $50 every Friday. When prices are high, your $50 buys fewer shares. And when prices crash, it buys more shares on sale. Over time, this lowers your average price and removes the emotion from investing entirely. Before you put money into any fund, spend 5 minutes reading its one-page fact sheet. Check the expense ratio and keep it low, under about 0.2%. Look at the top 10 holdings to see what you actually own. Glance at how it weathered past crashes. That is the whole game. Investment funds are not a lottery ticket, and they will not double your money overnight. They are a slow, steady wealth machine built for people who think in decades, not days. By pooling your savings into low-cost, diversified funds, you are buying a piece of human progress itself and letting it grow brick by brick. So tell me down in the comments, are you already holding index funds or ETFs? Or are you just starting out? If this breakdown made funds finally click for you, hit that like button. It genuinely helps the channel reach more people. Pick low costs, automate your savings, stay calm through the dips, and let time do the heavy lifting. Subscribe, and I'll see you in the next one.